If you are a successful small business owner or a high income professional practice owner, what is the best way to get six-figure tax deductions year after year after year? My name is Chris Hammond, Managing Director with Redwood Retirement Specialist, along with my partner, Jeffrey Mason. And we own and operate an actuarial firm that specializes in cash balance plan design and consulting. We also administer the plans for our clients every year. And so we guide you along the way from the start all the way through retirement. Now, what we want to do today is a quick, high-level overview using our modeling software to show you a great way to build a plan that gives you six-figure tax deductions every year while affording you the latitude to vary how much you are funding year to year based on your tax reduction and cash flow availability. So first, I want to contrast very quickly a 401k plan to a cash balance plan. A 401k plan is a defined contribution plan in that you basically say, I'm going to put X amount in the plan this year. There's no other parameters really guiding that other than the IRS limits how much you can put in into deferrals and profit sharing. And how you invest it is pretty much entirely up to you, as long as it meets basic guidelines. Cash balance plan, though, is a defined benefit plan in that what level of income are we aiming for in our retirement years to last us the rest of our life? And then we build the model backwards from there to determine how much we need to accumulate and accrue up to build that nest egg to provide that. In a 401k plan, you don't have a limit on what your account can grow to, but the limit on how much you can contribute each year is substantially smaller than what you can put into a cash balance plan. A cash balance plan does have a limit on how much you can take out of the pension in the end to roll over into an IRA or whatnot, but you are able to put substantially more in every year. And the focus is really on the level of contribution that you make to take tax deductions. And so I'm going to quickly show here what a typical outcome would look like for someone in their mid-40s. And that looks like this. So in this cash balance design, we have two buckets. We have a brokerage bucket and we have a qualified life policy bucket. Now, the plan is aiming at roughly $4 million in benefits. And you can see that the cash balance plan assets get to a little over that, 4.3 million. And so we also have a life policy that you are able to buy pre-tax dollars and have plan completion protection in the early years while you're paying the premiums over the first 7 years of the plan. After that, the level goes down a bit, but you still have a substantial death benefit at normal retirement age. And you also are building cash value in these policies, which are part of the overall plan assets here as you go. And there are numerous tax advantages to that. We can do a deep dive into that later. But the main premise is that in this case, we're building up a nest egg of 4.3 million that will provide roughly $343,000 a year in income for life. Now, really what you're going to do is you're going to roll over this lump sum into an IRA. And as you draw it down tax efficiently, you're going to be able to get a net after-tax value of 3.3 million in this scenario. And contrasting that with, after all taxes and expenses are also taken into account, what if you had dumped the money into a retail brokerage account instead of the cash balance plan model over this same 18-year time horizon? Well, in that case, the retail market account would be worth $2 million net of everything versus 3.3 in the cash balance plan model. And so the cash balance advantage in this case is just under $1.3 million. And the contributions that you are making to the cash balance plan model are tax deductible every year. And so after all taxes and fees are taken into account, your net tax savings is $1.3 million. And so just to quickly show this in a one-page glimpse, some of the assumptions that we take into account are payroll compensation, the annual benefit we design, interest rates and investment returns, what your current tax rates are, where they will be in retirement, plan retirement age, years to retirement. This time horizon is very important. What the benefits of the plan are. Total benefits are accumulating to 3.9 million. And then you're funding toward that every year. And so in this case, we have plan assets of the two buckets growing and accumulating together to 4.3 million. So we met all benefits plus some, and that's fine, giving you this projected income for life. So funding wise, annual target funding is about $150,000 a year, but we have a wide window. And as we go, that window gets bigger and bigger and bigger, giving you more latitude cash flow wise. And, if you have a year that you really need to make a large contribution in to take a bigger tax deduction, you're going to be able to do that. And so all said and done, we see we have tax savings and expenses netting to $1.3 million of tax savings over this time horizon for this particular case. We showed what the investment returns are, what the total benefits are. Again, plan assets is the same. And so then we have this graph. Now, the red line is the limit on what can be taken out of the plan for retirement. And currently that's $3.4 million, but that's going to grow over the next 18 years. The IRS indexes that every year. And an individual's limit falls under that and is developed over their time horizon, whatever time horizon they have in the plan. If it's 8 years, it accumulates very fast. If it's 20 years, it accumulates very slow. It also has to do with level of income and other factors and number of years of participation in the plan and things like that. The blue line is the $150,000 in benefits plus an initial part accumulating over this time horizon at a fixed interest rate. And then the green line is the actual funding that goes in and accumulates at a rate of return meant to match that interest credit rate plus some. Okay. And so you can see that as long as we get to the end and we are under the red line, we're perfectly fine. If we have too high of a return and we're way up in here above the red line, now we have excess assets that the IRS is going to tax the hell out of. 50% excise taxes, ordinary income taxes on the whole thing, a whole mess to deal with. And so as an actuarial firm, what we are doing every year as we govern the balance of benefits against plan assets is we determine where you are, where your red line is at, and making sure that our eyes are on the ball so that we don't get into that kind of situation. Really what we're looking to do is optimize the value of the plan for you and your tax reduction needs. And so in this scenario, again, down at the end, you can see that we have this life policy with these benefits, $6 million in plan completion protection in year one, and that grows for the first 7 years. Then it goes down when you stop paying premiums, but builds back up a little bit, all the way up to almost $2 million at normal retirement. This particular case is using $118,000 in annual premiums. This can vary considerably based on what fits for you. But again, the term is only 7 years. And in this case, the cash surrender value at age 62 is 1.1 million, which is part of the plan assets. Net after-tax value of 3.3 million versus if you had dumped it into the market, 2 million. Cash balance advantage, 1.28 million. Net tax savings value, 1.3 million. Again, this is just someone that's 45, 18 years out from that retirement age at a healthy level of income. There's a lot to dive into on how we consult on the compensation level and what you can really do with that. It's pretty fascinating, actually. But the bottom line is we tailor the design solution to you. Please give my partner, Jeffrey Mason, a call to discuss further. And we would be very happy to build a design that works for your needs and become great partners at maximizing and optimizing a plan that meets solutions tailored to help you reduce your taxes. Thank you so much.